The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Okay, good afternoon, folks. Thank you all for coming in. The number is 877-927-6648 if you have any questions, and we will try to answer them if we can. The first chart that I've posted into Tiger TV today is the chart on Apple. I posted the daily chart, and then I also posted the weekly chart, and if we get much below 430, that sets up the objective that we've been waiting for such a long time, and that's that $394 per share trade target. Now, remember, Apple has been much weaker than the market, so it doesn't take much for it to get there. Now, on long weekends, because I kind of love this business too much, I spend a lot of time, looking at charts over the last 54 years, probably too much, I guess, but it's what I enjoy doing. And what I decided to do today is let's just look at the world, where we are with these patterns. And I'm going to start in Europe and go to the United States and then go to Asia, just cover the whole thing. I did not do India because that, not that I don't count it, but it pretty much tags along with what China is doing. 20 years from now, America will be, probably number 3 in the world, maybe less time, I don't know. But, they have so many people that once they start to earn money and become consumers, that will put us into the GDP category of, Japan or something like that. So we'll see. But anyway, the first chart I'm going to post in here is a long-term chart for the German market, the DAX. This was provided to me by one of my good friends and colleagues and students from New Zealand, who is an exceptional trader. And it basically shows, the big double top pattern that we're having from the 2007 area, and it shows the big butterfly pattern forming in the 3-drive pattern, just exactly like we have happening in the NYSE index, but the NYSE index is only coming in at the 786 retracement. So here we have, the German market, completing, one of the, large patterns that we have, going on in the world. Now, the next one that we want to look at is we're going to go to London, and we're going to look at the FTSE, and this one has some really beautiful harmonic things that are occurring. It's quite a bit under the top, the double top that we made in 2007. And if you'll study this chart just a little bit, you'll see that in 2007, that also made a double top. See, double tops are one of the, famous patterns because it really, gives the person a chance to, get back in the market or to get short, whatever you decide you'd like to do. But this has many beautiful harmonics, A, B, C, D patterns that have completed. There actually are 3 on this particular chart, and realize this is a weekly chart, so it goes back, we're going back 6 years, so that's really, a really big thing to look at. So we've got a lot of these patterns on the worldwide basis, that are doing this. The reason why I'm saying that is because I think we're at a very critical market junction where we could really, run into a great deal of trouble. Okay, now we're going to come to the USA, and here we have the New York Stock Exchange Index going back to 2007, and if you'll study that chart just a little bit, you will see that in 2007 we made a slightly higher high for 2 weeks than we did in 2007. That's when Bernanke came out and said he could see nothing wrong, with the housing market, and everything looked good, and there was no warning of credit default swaps or CDOs or any of these things that have caused, such great problems. As you can see from this chart, the Dow Jones has actually, taken out that high, but that's only 30 stocks and they're price weighted, so that's not the real market. The real market is the New York Stock Exchange Index, and this is a weekly chart. It has the ABCD patterns forming. It has the three drives patterns forming. It has the butterfly pattern forming. All of these are coming. So we've gone from Germany, we've gone to London, now we're in the United States, and now we're going to take our next trip and we're going to get on a plane, usually Cathay Pacific, flight number 882, going into Hong Kong, a la China, and we'll take a look at the Chinese market on the weekly basis. And you can see the real discrepancy, in the Chinese market. If this market was supposed to pull everybody out of the doldrums, it certainly has not. After we made that big spike high in 2007, we have, barely made a 50% retracement, back in 2010. But on this last retracement, we were barely making the 61% retracement. And we topped, at least 10 weeks ago in the Chinese market, and it is not rebounded at all. So as we go through these, you'll see that these charts are not looking very good on a world economy type basis. Now, realize that these are charts, folks. These are not the fundamentals. I don't look at the fundamentals because I don't trust the numbers. You can see that in so many numbers around the world that when you see these, that you have a different opinion on everything, and even in charting you have a different opinion on everything. But the way I look at it is that if prices are going up, there's more buyers. If prices are going up, there's more sellers. That's what you really need to know about economics, in my opinion, because you're trying to make a living at this, and you can't believe anything that people say, a la me too. You have to do the work yourself. Very important. Defy human nature, do the work yourself, just like Jim Twentyman's always said. If you do the work yourself, you have the responsibility. You're the one that reaps the profits. All I'm trying to do is to give you some really good, in my opinion, I think they're really good ideas on what these patterns mean and how they, actually work. So our plane is in the air. We're getting ready to fly into Tokyo, Japan, and we'll take a look at the Japanese stock market. And as you can see, we had a pretty good top in 2007 at 18,000. Now, folks, my data on e-signal here does not go back to 1989 in December when the Nikkei was topping at 39,000. That's when all the newspapers were showing 40,000 on the Nikkei. It was the biggest market, in the world. We had already gone through our crash, and the Nikkei had already recovered and gone up another 30% after our crash of 1987. But since that time, since December of 1989, the Nikkei gave up almost I think it was 85% of its move. It went from 39,000 and change to just under 7,000. I think it slightly ticked under 7,000, around 6,900 back in 2003. And then we had the rally that, of course, went up to 18,000 in 2007. This past rally has been the weakest on a longer scale between 2009, but the last part of the rally that started last January when we had the higher bottoms and we were looking at it from the long side has, accelerated pretty good. So if we can get the Nikkei above, 13,000, then it's got a chance, to turn around. But frankly, it's looking, less and less like it really wants to, go any higher. So that's what we're looking at as we go around the world. And I think that if I have one other one to cover. If you'll bear with me here 1 second, I will bring it up, and that's the emerging markets. These, I believe, are the things like Brazil, Argentina, places like that. India happens to be in one of those, and you'll see that this is an ETF for or it's an iShare, one of the two, I'm not sure, but EEM is the signal. It's a monthly chart going back to 2007, and you can see we have lower tops all across the thing. The last high this thing was made was in 2011, back in February, and then we've had two lower tops since that time. So this is also, in a considerable downtrend. So when you look at the world and you look at all these charts, I know they're bantering about the fact that the Dow Jones is making a new high, but folks, it was making that same double top back in 2007, and everybody was, happy and yelling and screaming, and we'll see that what happens. But anyway, these are on the they're in downtrends. That's the bottom line on emerging markets in Japan and China. These are in major downtrends. Whereas we're making a double top in the Dow Jones with all these pattern completion. I tell you this because you have to be extremely careful up in this area because you don't want to be trapped into a situation. The headlines of the Wall Street edition of the Wall Street Journal edition, weekend edition, has a big front page picture, and the salutation is, "Mom and Pop are back in the market." And I sure hope they're wrong this time. But if it were on Time Magazine, it would probably be a mortal lock that we were topping. But the fact that they're talking about Mom and Pop getting back in the market is not usually a good thing. So this is what we're looking at, on what is happening. When we take a look at the VIX index, which is one of Basil's favorite, and also I like to look at it, for measuring fear and greed because it's probably one of the better things that we have. We have a 3-year cycle that we've been talking about for a long time. We had the butterfly pattern form, just a week or two ago, and so far it has held this bottom. So that's telling us that the fear and greed could actually do this. But remember, this has, they call it the volatility index because that's what it is, because it can get really volatile. As you can see from the spikes that we had in 2008, 2010, and in 2011, those were very, very small spikes that only got to 42. I assume the next spike we get has a possibility of taking out the old high at 89. And whether that's going to, occur or not, remains to be seen. But the thing is the whole world is bullish. All of these patterns on a worldwide basis. No matter what country you look at, I couldn't find one that was bullish. Look extremely bearish, and this is not the time to, be in a bearish mode. That's the way the chart patterns look to me. That foregoes any economic, data because I don't believe what they tell me. Okay, we've got to take a little break here.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC. McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Wealth Management. Simply picking the right stocks is not enough. Research has shown that choosing the right proportions of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley believes a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what an asset allocation and a Morgan Stanley Wealth Management financial advisor can do for you. Call Angela O'Brien, First Vice President and Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Wealth Management, LLC. Member SIPC.
This segment is brought to you by Great Panther Silver. For more information, just click the Great Panther Silver banner on the front page of TFNN.com.
Okay, folks, we're back, and we have a special guest coming into the office right now. Just a second. Hold on. He's getting here. Well, I'll be darned. It's Santa Claus. He's coming early. Holy Toledo, what can you ask for? What Santa has for us today is a chart on the Treasury bonds on a weekly basis. And we have been watching this for a long time, and if we get a sell-off in the stock market, folks, we have a chance to make this head and shoulders pattern that we've been waiting for in the Treasury bonds, somewhere between the 149 level and 147 level. Would like to see that occur over the next 3 to 5 weeks. If it gets really crazy, what can happen is you could get even a 3 drive to a top pattern, making bonds into a new high. So this is what we're waiting for. It's got a real chance to do it. If you'll take a look at this chart, and if you go into Tiger TV, you'll see that the head and shoulders pattern is forming up just beautifully, and then we will. That would really be a Christmas present. So that's what I'm looking at. With the bonds, it looks pretty good. There's so many crazy things happening in these markets that it's absolutely amazing to me. The next chart that I'm going to post into Tiger TV is the high-grade bond chart. This is also known as the junk bond chart, and as you can see, they are clamoring for yield so much that the junk bonds are outperforming the AAA treasuries. A junk bond for American Airlines, which is in bankruptcy, by the way. They issued bonds while they were going through bankruptcy, and they came out with a yield of better than 4-something%, which is even better, just slightly better than the yield on a 30-year mortgage, which is backed by, some property. So this is real interesting how people they're just clamoring for yield because they have to have yield, and that's what we're looking for. But the bonds are on the radar. That's all I know. They're not shortable here because I believe we're in the midst of a correction in the stock market, if not one of the most major tops we've ever had, and that would cause a flight to quality. And that flight to quality should take the bonds to 1 to 2 levels, either into the 148, 149 level, which is the 61% to 786% retracement of the high we made, or if it's really bearish and we really have a big sell-off in stocks and there's a real serious flight to quality, the bonds could go all the way up to the 157 level. And as we get to 157, those of you that listen to TFNN, you're only 3 points away from the little wager that Tom O'Brien he and I have, and that is that the bonds could make the price of 160. And believe me, the difference between 157 and 160 in Treasury bonds can be covered in a matter of a few minutes. So there is a possibility that we could do that. The target would be between 149 and the 160 level, but we'll have to wait and see how this pattern unfolds. But it is really setting up just as nicely as any chart pattern that you could possibly ask for. So that's the real key that I'm watching in the bond market. The fact that these people are just clamoring for yield. They don't care about the risk, which the volatility index is telling you that in the stock market, but it's the same thing in the bond market, is the fact that they're not giving you any indication that there's any risk in the world at all, and that's the real key to some of these things that we're looking at. Someone asked a question about the correlation between the U.S. dollar and what's happening in the stock market, and I'm going to post into on Tiger TV right before the break here that we have the U.S. dollar index on a weekly basis, that it made that big Gartley pattern up at that 83 level last week and the week before. It tested both times, and it shows the price of the S&P cash over this, and you'll see that there's a very slight correlation at times, but in general, there's not much of a correlation. For trading purposes. For long term, you might be able to find something, but for trading purposes, the correlation, really does not exist. I apologize a little bit for my scratchy voice today because we are in the midst of the spring blooming here in Tucson, Arizona, and it is really, very, very beautiful here, but boy, is the pollen really, really heavy. We have to take a little break here, pay a few bills, 877-927-6648.
Just recently, on December 28th, Market Insight subscribers were advised to go long the QQQ, the NASDAQ 100 ETF, on December 28th at $63.91, and only 2 trading days later, after a huge jump in the markets, Market Insight subscribers were advised to sell the QQQ at $66.64 for a $2.73 or 4.27% profit to start off 2013. At the same time, Tom O'Brien had advised his clients looking for a more leveraged trade that they could have initiated a position in the QLD, the ProShares Ultra QQQ ETF, and over the same 2 trading days, Market Insight subscribers were able to lock in a $4.48 profit or an 8.47% gain in just 1 trade. Get your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. Cancel at any time during your free trial and pay nothing. Don't miss out on the next great trading opportunity in 2013. Act today. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil's subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page of TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com.
Okay, folks, we're back. And I wanted to bring you up to date on the show that we did Thursday, where we had Rich Anderson on the as our guest from Anderson Capital Management. It was that was the final crop report of the year, and it was a huge surprise. It took all the grains, down big time. And all I wanted to do now is to give you an idea, of what happened. Overnight, and then again today we gapped down again and dropped another 30 cents in corn, and it's going to be really interesting because we could go all the way down to the 5.45 level per bushel, and that's going to be really good. Now remember our buying time frame for this is in the labor Memorial Day weekend, much like it did last year. But this year the swings are bigger because this is where they changed the rules. Now, folks, I bring this to your attention, too, because it happens in other markets also. If you remember Apple, how wonderful it was at $700 a share, and it was, people were standing in Times Square paying people $100 and $200 to wait in line to buy the new iPad and stuff, and they were selling them for triple the value on eBay and things like that. Those days are over. And the same thing with corn, that those days are over. When corn was making a top, up to the $8 level, completing that big, butterfly pattern, then it was totally different. So this is why I'm bringing these charts to your attention, is because this is the longer-term view of it with the economics, because it's a sum total of all the buyers and sellers. This will turn into a really great buying opportunity, but it certainly isn't now because the risk is really far, far too great. So you don't want to, step in and try to, buy anything like this. This is not the time. They've said that this is a big game changer, and they certainly are right so far. Now we are looking at we're going to go to the currency markets here for a second because we're at real critical levels in the currencies. First thing I'm going to do is I'm going to post the hourly chart for the euro. It goes back about a month, and it shows that three-drive pattern that formed down at the 127.50 level. And then since that time, we've had a ABCD swing that completed up at the 382 at 128.67. That's really, what we've done. Just in the last 5 or 6 days, we've had a little bit of a rally. Now, longer term, when you look at the euro, there's a far, far different picture in this. If you look at the weekly pattern in the euro, and you'll see that we topped in the euro, way back in 2007, right after the market topped, and we've had 1, 2, 3 major Gartleys in the last several years. We just completed the one recently up here at the 137 level, and now we've come down, and we've been down for 8 weeks. So what we're seeing now in the euro, like we looked at on the 60-minute chart, is just we're seeing is the first of a rally, and this rally could go all the way up, to the 133 level. But a longer term, the euro looks, extremely bearish. It just does not have many friends, and that's money moving. This is the biggest of all the capital moving, folks. The euro and the dollar. There's nothing any bigger traded. It's thousands of times bigger than the stock market and the bond market. So, this is where money is moving. So it's having a little bit of a rally, coming in at these times, that we see right now. The next one I wanted to bring to your attention is the Japanese yen versus the U.S. dollar. And you can see this on the weekly basis that we went up to that 786, up at the 96 level. And now what's happening is, we're having a little bit of a correction. In fact, as a matter of fact, as we're speaking right now, as we're speaking right now, as we're doing the show here, we have a real interesting pattern forming that I want to bring to your attention. It's an hourly chart on the Japanese yen. And those of you that look at Forex, I'll try to, give you an idea of, what we're watching here, because it's real easy to see once I can get the chart, set up to do there. There we go. Okay, this goes back just about 5 weeks, and it's a hourly chart, and it's going to be interesting because we are setting right at the 61% retracement, almost exactly as we speak. The number is 93.05, and so far we've been down to 93.07. So it's very, very close. And if you'll notice, it has the same similar type pattern that we have with the euro. Now, this has taken a long time for the market to make this correction. So this is a very low-risk buying opportunity in the dollar versus the Japanese yen, because the long-term trend in this is extremely bullish. I mean, we came out of this trade. In fact, that was one of the trades that Tom O'Brien, was talking about, when it was trading around the 75 level, and we focused on watching it make those higher bottoms all that time. And that's why, it has such a really, really strong trend involved. And what you're looking for is you're trying to find, spots where you can actually, get a place where you don't have to risk, an arm and a leg when you're doing these things. So that's the main thing, is to keep an eye on this, because this has a long way to go. The correction might, accelerate to the downside, but the risk at this particular point is very, very small, because you're completing such a beautiful pattern, on the hourly basis, and you don't have to risk very much. You're talking about something that's got a $100,000 contract size, and you only have to risk around $400. It's very, very small risk at this 93.05 level. So it's important to keep an eye on it, and whether it's going to work or not, I don't know. But boy, it's got all the things that you like. It's got the ABCD pattern. It has the retracement, the 61% retracement, and it also has several ABCDs that are lined up in there. So that's what's interesting. So we'll see. Since we've been on the air, the first charts that I posted were for Apple, and we've now broken below the 786 in Apple, which was around 434 per share, and that's not a good sign. And so we'll see if we're going to make this target that we're looking at the at the $394 per share level. We'll see if that in fact does that. But we'll see. Now the secret to the when I post a chart in here, folks, I hope you realize that we're dealing with risk management here. You don't have to be a rocket scientist to do this, but you do have to use good money management. If you remember on Thursday's show, I told you the story about the trader that had a lot of things go wrong in his life. His wife left and left him with the kids, and his father died, and all during that time he was trading, and yet he still break even. He actually made a little bit of money, and he was very down on himself, and he sent me a letter. And he also called me, and I listened to him, and I told him, I said, anybody that can trade through all of that and still be even, you're on your own way. I said, you've got to stay with it because you're a great trader. The first call that I made was to Mark Douglas, and Mark said, I gave him the scenario, and he said the guy would have lost at least 50% of his money, if not all of it. And when I told him that the guy had made money during that time, Mark said, there is a superstar in the making. He said, I can tell you that. Well, I got a really nice email today from him, and he did continue trading. He started Sunday night, and he had one of his best days ever Sunday night. He literally put a couple of currency trades on and went to bed, and when he got up, he had a huge profits, and so I told him, I said, it's just probabilities. You're going to be wrong a lot. Trading, you have to take losses. It's like breathing. If you don't take losses in this thing, you're doing something wrong, because that just means you're on an incredible lucky streak, and this has nothing to do with luck. Luck is where preparation meets opportunity, and that's what we try to do is prepare these trades. Some of them work, some of them don't, but that's all it is. It's just preparation and opportunity. And so if you remember, in Chinese culture, the word for opportunity and the word for risk are exactly the same thing. It's the characters are the same. It depends on how you use them in the sentence. And that's pretty much what the trading is exactly all about. It's about quantifying your risk. That's the whole key of what we're trying to accomplish. Okay, now the next one we should talk about. We went into the currencies and things, so we have to move the party along a little bit. I wanted to show you what's happening. We've mentioned this several times. This is the gold and silver market. Gold is becoming a big disappointment, folks. I know it's up a couple bucks today. Silver is getting hammered again because it's an industrial metal. Copper is breaking down below the lows of last week. We had that little marginal rally where it rallied to $3.43 a pound, and now once we break $3.30 a pound in copper, which is not very far away, 6 cents, the only friends it's going to have is at the old double bottom, and that's down at the $3 per pound level, another 10% lower. So all of these things are telling us that even though they're telling us that the economy is wonderful via the U.S. stock market, these commodity markets are rolling over. I mean, we got the grain markets. They are falling out of the sky. Believe me, they are, limit down Friday. More action today sharply to the downside. So the grain markets are falling apart. The industrial metals are falling apart. Silver, palladium, platinum, all of them are, breaking down badly. Copper, breaking down badly. These are not bullish things, folks, for the stock market. Because they make products to sell to people out of these things, and they are not going up, and that's a bad sign. And in particular, the gold market, because the gold market, should have had a much better rally in this run than we've ever had. Now, I'm going to post the chart for gold into the Tiger TV because it goes back a little over 18 months, and it shows, we had this big sell-off that's, went down to the 1525 level, which was, considerably below the 786. The time frame that it did it was perfectly because the time down in all three of the moves from September, December, and February were all equal. In other words, the same number of days made the market go down, which is part of the AB equals CD formula. And then we've had a very, very marginal rally that went a little better than, $60 per ounce, which were equal to the other rallies that we had. I mean, the other rally that we had in November, January, and the one in March, they were all equal at around $60. And so this is telling us that we have a market that really doesn't want to rally very much. Back in the old days, something like what happened in Cyprus, and would have sent gold soaring. But even more important than that, if the thing with North Korea, I know they're probably not going to do anything. He's just playing poker, with the rest of the world, and everybody knows or everybody thinks he's bluffing. That would have made gold jump at least $50 to $60 in a quick move. We have not had that. We've had very, very orderly, market in the gold, and that's that's really not a good thing. Now, we have a very powerful ABCD pattern forming in gold, and it comes in at the 1584 per ounce level. So anything below 1584 per ounce level would be construed as being negative, in my opinion. So gold is not acting, like it should, folks. It's just not. It's not giving up anything as far as an idea that there's a flight to quality there. And I always have gold. I have some gold and some silver, and all I'm looking at is from a trading basis here, because if the gold starts to break, it's going to break way below the 1525 per ounce level, because we had a very, very small rally. The last rally had was just barely at the 382 retracement, and that means gold is not looking very good right now. Now it's held the level that we were looking at for a shorter term time frame, but frankly we really need it to get be moving. I'm going to post that shorter one because you'll be able to see it in the Tiger TV here. This is one. This is an hourly chart on gold going back the last month, and you'll see that it is completing an ABCD level at the 1582 level per ounce. Oh, by the way, that wasn't really Santa Claus that came on at the break. That was my attempt at the April Fools. So I know it didn't work out as well as that move.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, David White, Larry Pesavento, Victor Jones, or Daryl Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, folks, the next chart we're going to talk about here is one that we all use each day, and that is the crude oil market. We have attempted the 786 retracement again up at the 97 level. That's pretty much where we're trading right now. If we can, get above the $99 per barrel level in the crude oil, we have a really clear shot at the 109 level. That would be a very, very large, ABCD pattern completing at that point. But frankly, it's a toss-up from this level of whether it's going to, make that level or not. We'll have to wait and see. I wanted to post into Tiger TV the DBC, which is the ETF for commodities. That's a broad-based commodities, far better than the other ones, that we're looking at. This covers just about everything is what I'm trying to say. And as you can see, we've had, lower tops, ever since 2011. And on this last rally, we had a very, very minor, ABCD move. And now with the, the price of all these commodities breaking down, silver and platinum, palladium, copper, wheat, corn, beans, rice. I mean, everything is getting hit, really bad, with the exception of cattle, and we happen to be long cattle, and so that one's acting okay. But the market just looks bearish, and that's not the sign that you should be seeing if this was a rip-roaring economy and everything was copacetic, and it's not. It's just not showing it in the charts. And remember, the stock market is not the economy. It's a market for stocks. That's all it is. And they move things rapidly. I remember one of my favorite quotes from Bernard Baruch's My Own Story, which was his autobiography. He said that the greatest scam on Wall Street is to inflate prices to a very, very high price, and he said you will get people to buy it all the way down thinking that they're buying value. And that was his summation of what he thought the stock market was. Remember these spikes that we've had in the past that we tried to go, walk you through them. One was in silver, when the whole world said it was going to $100, per ounce, and the rest of the things that we looked at in silver said, no, it's not, because, players were leaving the market. So these are things that you try to add to the technical part of the picture that you're looking at to keep you from making, a really, really, drastic mistake. But we're in a very interesting time, to say the least, and that happens to be a Chinese curse. May you live in interesting times. But the rest of the world is making major pattern completions. Asia, including Hong Kong, and I didn't put Hong Kong in because it's a smaller market, even though it is a big one. But if you look at all of Asia, all of those patterns are either in bear modes or are completing major technical tops as we see them from a pattern recognition standpoint. That's the way I see it on a long-term basis. As a matter of fact, as I was going through the charts, I tried to search my memory. Had I ever seen anything like this before? After looking at charts for well over 55 years, and frankly, I have not. I've never seen so many of them, all doing the same thing at exactly the same time, which is a very troublesome, in my opinion. I think that there's something really ominous might be coming down the road. I'm not sure, what it is, but, we'll have to wait and see if it does. Now, if the stock market does break, folks, it's not going to go straight down, I can promise you that, because the shorts are absolutely scared to death. Listen, that's it. We'll see you all on Wednesday. Live every day in an attitude of gratitude, and may God bless.